Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning. Last week of July, moving into August. Hope everyone had a great summer weekend. Enjoyed myself. Was out last week. That's why we didn't have a call. Glad to be back. And a bunch of things to go over, talk about this morning as the unique situation that we are all living through continues to surprise and unexpected twists and turns. So I think be some interesting insights and ideas from today's call to discuss what's going on in the marketplace and how to best position ourselves depending on our risk-reward profile for both investors as well as advisors who are working with investors. So we're going to get started this morning and we're going to talk about something on the technology side, something that hopefully will be of benefit to perhaps many of you individually. And this is something that I had read last week in the Wall Street Journal, and it has to do with something that we all do consistently and not necessarily always think about. That is, every time we go to our computer, we almost always open up a browser, and we really don't think much about that browser when we do that action. And the most popular browser is Google Chrome, and then that is followed by some of the companies that are starting to aggressively nip at Google's heels, and these are former market leader Microsoft as well as Apple with their browser Safari. And Wall Street Journal said the good news for us as users and consumers is that the battle for browsers is about to get a lot better for consumers. I mentioned that Chrome is the most popular browser. Many of us may use it as our default browser. It's got 69% of the desktop, laptop browser market share. But the good news is that their competitors are really laser focused on catching up or outperforming Chrome, and perhaps some of us should think twice before we default to just choosing Chrome. And the reasons why we may want to do that are twofold. One is because both Safari and Microsoft's new Edge browser provide more security as a default, number one. And number two, they are each typically faster, and I'll get into some of the specifics here. So Microsoft, if you're a Windows user, as well as if you're a Mac user, but the real strength is on the Windows side, recently launched their new Edge browser, rolling it out to Windows 10 machines recently this summer, and it is now also available for download on a Mac. It's based on Chromium, which is the same underlying technology as Chrome. But it uses less of your Windows computer RAM and uses less battery power. Meanwhile, Apple's built-in Safari browser has a very attractive blend of privacy, performance, and battery. This is something that is available on Macs, and it is expected that Safari's performance will get better this fall when Mac rolls out their new operating system, Big Sur. So if you have Windows, the author here in the Wall Street Journal says that the Microsoft Edge, in her opinion, is a no-brainer. The company hasn't had a great browser like this since 1996, she says. Across her tests, the new Edge used about 5% less RAM. While that may not sound like a lot, for example, if you're using a laptop, that could result in as much as an extra hour to an hour and a half of extra battery life. Also, the Edge, she said, pages loaded super fast, and you don't have to worry about compatibility issues. So if you're using lots of Google apps, including Gmails and Google Docs, The new Edge browser builds those apps in, and they work seamlessly. Also, if you're using Microsoft Edge, they've recently added a new functionality, something called collections, where you can lump together all the links from a particular project. So, for example, if you're shopping for something like sandals, and you pull together a bunch of websites that you're considering different sandals from, you can put them all together in a collection and go back to it and look at it as a unit, so you don't have to keep clicking around and trying to find what you're looking for. Also, in Microsoft's new browser, there are 3 levels of privacy controls, and the middle balanced mode is the default mode, and that blocks trackers on sites you haven't visited before. Helps minimize the ads following you. So, when you talk about, buying yourself a new shirt, suddenly, you're looking for shirts with stripes, and suddenly every web page you're looking at has shirts with stripes. Perhaps you're using Chrome and there's less privacy. This helps minimize those ads if it is turned on. You can also switch to a much stricter mode that blocks the majority of trackers on all websites. So comparing that to Chrome, in order to disable many of these functions and features, you need to disable cookie tracking in settings, and you also need to install a third-party privacy extension for deeper controls. So the privacy and the ability to limit how easy it is for these sites to track you is much more difficult in Chrome, at least at the moment. Google has said they are considering making changes. If you have a Mac, the browser that provides the best performance, perhaps not unsurprisingly, is Apple Safari. It uses about 5 to 10% less RAM than Chrome, providing an extra 1 to 2 hours of performance or battery power on a single charge. Interestingly, also, if you're running Safari versus Chrome, your laptop will be cooler and quieter because it is working less hard. Also, Safari is building in support for Google Apps as well. And when the new operating system, Big Sur, rolls out in the fall, it's expected that many of those extensions, in order to use some of the Google app extensions, will work seamlessly for you for a Mac user who is interested in using some of those Google products. Safari has lots of privacy features, including tracker blocking. The upcoming version includes a toolbar that lets you see the blocked trackers on the site you're visiting, and it also provides you with a new weekly privacy report showing you all the blocked trackers, and that will apply across your iPhone and your iPad as well. So moving on to financial markets, taking a look at where we are this morning. We are seeing futures right now to the upside. Dow futures are up about a little over 100 points. S&P futures are a little over 15 points above fair value. This is investors await the coronavirus relief bill negotiated by the White House and Senate Republicans. Reports indicate the bill is going to cost at least $1 trillion. $1 trillion is significantly less than what Democrats want. Politico is reporting that GOP lawmakers intend on releasing their version of the bill around 4:30 Eastern Time. Obviously, after the close, related headlines could be announced throughout the day. Secondarily, mega-cap technology stocks are providing some solid support for futures trade this morning. This is after 2 weeks of large-cap consolidation. On a related note, several big tech CEOs will be testifying before Congress on Wednesday regarding antitrust concerns. On the data front, at 8:30 this morning, we got June durable goods orders. They came in up 7.3%. Expectations for about a 6.5% rise on those numbers. If you factor out transportation, the number came in up 3.3%, which was in line with expectations. U.S. Treasuries, little change. Precious metals extended their recent rally amid continued weakness on the dollar. Dollar is down about 0.7%. Gold is up over 2% this morning to about $19.40. Some are saying the march towards 2,000 is well on, and the drumbeat there continues. If you've been following the news flow for the past few months, you're starting to see an acceleration of that trend, which is dollar weakness, and that is translating into some commodity strength, in particular gold. Oil up slightly more this morning. We'll talk some more about that when we talk about some articles in Barron's, because I think it is an important trend. Other companies in the news, Moderna, symbol mRNA, is up over 8%. After being awarded up to $470 million from the Biomedical Advanced Research and Development Authority to develop its COVID-19 vaccine. Amazon this morning is up about 50 points, or 1.5%. Telsey Advisory Group raised its price target on Amazon to $3,600 from $2,800. Also this morning, J.P. Morgan was upgrading Apple. And they upgraded Apple's price target to $425 from $360. Apple's up about 1%, about 4 points this morning. In the airline space, American Airlines was upgraded to market perform from underperform at Raymond James, slightly to the upside there for American Airlines. Hasbro, symbol HAS, is down 4.5% after missing top and bottom line estimates. Equity markets in the Asia-Pacific region began on a mixed note. Japan down 0.2%. Hong Kong down 0.4%. India down 0.5% on the plus side. We had China, South Korea, and Australia up anywhere between 0.3 and 0.8%. In Europe, we are seeing markets there mixed as well. Markets basically trading anywhere between roughly up 0.1% to the worst performing market, which was Spain, which is down 1.7% after an uptick in some coronavirus cases there. The news this morning, perhaps getting the greatest headlines, is news that the Chinese have entered the consulate. The U.S. officials entered the Chinese consulate in Houston shortly after the passage of Friday's deadline that was given to the Chinese diplomatic mission. China responded by seizing the U.S. consulate in Chengdu this morning. So the tensions there continue. A lot to look forward to this week. This week is chock full of earnings, as well as actions by central banks, in particular. Perhaps action or inaction, but important what they say by the Federal Reserve. So biggest event this week, perhaps, is the Federal Open Market Committee announcing its monetary policy decision on Wednesday, July 29th. Expected to keep interest rates unchanged at near zero through 2022. Markets will be watching what the Fed has to say about their policies, about their market purchases. So get more clarity perhaps on Wednesday. Earnings really start rolling in tomorrow, Tuesday. We get earnings from AMD, Altria, Amgen, eBay, McDonald's, Pfizer, Visa tomorrow. Also, we get consumer confidence for June coming in tomorrow. Wednesday, earnings from PayPal, Sanofi, Shopify. Thursday, some of the largest tech names, Alphabet, Amazon, and Apple, all on Thursday. We also get earnings from Procter & Gamble, UPS, Ford, Gilead, all on Thursday. Also, one of the big economic reports coming out this week is on Thursday, when the Bureau of Economic Analysis reports gross domestic product for the second quarter. Consensus estimate is for a decline of 34% after a 5% fall in the first quarter. That would be the largest quarterly drop ever. And markets will be focused on exactly the extent of the drop, as well as the potential for a rebound, and that obviously has a lot to do with the coronavirus and how it manifests itself in the next several months. Friday, we continue the earnings parade. We get earnings from Colgate-Palmolive, Exxon, Merck, Under Armour, to name a few. And then on Friday, the Institute of Supply Management releases the Chicago Purchasing Manager Index for July. Expected to see that number remain below 50, which is in the contraction phase, but up from the previous month. We're looking for 42, up from 36 on Friday there. So moving on to Barron's. I mentioned the dollar, and Barron's ran an article entitled "Another Reason Tech Stocks Tanked: A Weak Dollar." Tech stocks, again, tank is perhaps all relative to the tremendous performance that tech stocks have been demonstrating over the past few months. Weakness in tech stocks modest relative to the rally that we've seen. What we did see is the NASDAQ finished with its first consecutive daily losses in 48 days on Thursday and Friday. So like I said, everything's relative. The dollar's drop wasn't the only reason for the NASDAQ's retreat. But of all the reasons for the tech-heavy index's decline, it did get the least attention. The NASDAQ last week fell 1.3%. It's at 10,300, so still firmly above that 10,000 level. The Dow last week was down 202 points, about 0.8%, and then S&P was down about 0.3%. You could point to a number of reasons for the market's latest decline. Corona cases have continued to rise in places like Arizona and Texas. The Senate last week was struggling to agree on a fiscal stimulus package. Also last week, the latest jobs reports was weaker than expected. Then there were earnings from some of the most popular tech companies, including Microsoft and Tesla, but were fine, but didn't live up to the lofty expectations. So the tech selector sector, Spider, was down about 1.2% last week. That's XLK. That brings us to the dollar. The U.S. dollar index, which is DXY, which tracks the strength of the dollar versus a basket of developed market currencies, fell 1.7% last week. Continued weakness this morning. It's now at its lowest level since 2018. The drop shouldn't be taken as a sign that something is wrong with the greenback, at least not yet, but that something is going on outside the United States. And that is what's taken place in Europe, where strong manufacturing and service surveys and the passage of a fiscal recovery package, as well as mitigation or more control, at least that's the situation presently over the coronavirus, has helped buoy the euro. And what does all that have to do with tech? Well, a lower dollar makes it more expensive for Americans to buy foreign goods, as it causes the price of foreign goods to rise. So a declining dollar helps increase inflation expectations, and what that does is supports cyclicals and risk-on factors. So what does that do? That encourages perhaps investors to start looking outside the United States. When investors focus on the U.S., they tend to focus on our large mega-cap technology companies. And perhaps with the dollar showing some signs of weakness, that investors may start to look at areas that benefit when their currencies strengthen, and this could cause a rotation out of some assets in the United States into assets of developed markets and emerging markets, especially as markets have stopped moving in synchronicity or tandem, and this is leading money managers to start consider moving assets. Historically, when you see dollar weakness, you see strength, particularly in European value stocks. On average, when the dollar is below its 50 and 200-day moving average, European value indexes have moved up anywhere between 15 and 20%. And emerging markets tend to outperform as well. So perhaps we're starting to see some of that shift taking place. Related to that and the weakness in tech, Barron's wrote an article. If the big five tech stocks falter, they'll take the rest of the market down with them. They're talking about the U.S. market. They started this article with a quote from Herbert Stein, who was President Nixon's Council of Economic Advisors. If something cannot go on forever, it will stop. That became known as Stein's Law, and that is a useful reminder that seemingly unstoppable trends have limits. The latest application appears to be the apparently irresistible outperformance of giant technology stocks that have not only led other equities higher, but also dominate the major averages that are weighted by the market capitalization, such as the S&P 500. The good news is the strength of the five biggest stocks, Facebook, Amazon, Apple, and Microsoft, and Google. They have lifted the S&P to within 5% of its record set in February. The bad news is that this concentration recalls past peaks when behemoths' outperformance couldn't go on forever. The large cap tech stocks, Goldman Sachs has dubbed them no longer FANG, but FAMG. I don't think I can pronounce that, but it's FAAMG. and FAAMG is the Facebook, Amazon, Apple, Microsoft, and Google. These 5 stocks have added more than 1/3 to their market values in 2020 during the sharpest recession and during the sharpest recession on record and the pandemic. And that performance has allowed the S&P to be up 2% this year, and that has taken place. That 2% rise in the S&P has happened while the other 495 companies in the index are down on average about 5%. So the index is up 2, 5 stocks are up. On average, the other 495, of course, not every single one of them is down, but on average, the other 495 are down 5% on average. When you take a look at those 5 stocks in that FAAMG, they now make up 22% of the S&P 500, just those 5 companies alone. That's up from 16% a year ago, and it's up 18% from the dot-com peak when the top 5 stocks in the S&P 500 made up 18% of the index. Of course, the makeup of those stocks is very different than it was back then than it is today. The only stock that remains in the top 5 is Microsoft. If you go back to 2000, the other 4 were Cisco, General Electric, ExxonMobil, and Intel. Interestingly, simple arithmetic limits the continued outperformance of the biggest names, coming from Goldman Sachs. And they say that's because many portfolio managers have 5% limits on any given stock. And Goldman strategists have deduced that the average large-cap mutual fund already has a 5% position in Microsoft, and on average has about a 4% holding of the other big 4 names. Also, when you take a look at the averages and you do some math, interesting that if the FAAMG stocks decline by 10%, in order to keep the trading flat, in other words, in order to keep the S&P 500 unchanged, if the top 5 stocks were to decline 10%, if you were to look at the bottom 100 stocks, assuming that the other 395 stocks did nothing, if you were to look at the bottom 100 stocks, those stocks would have to go up by 90% to make up for a 10% decline in the top 5 stocks in order for the index to remain unchanged. Just to put some perspective on how much influence those 5 stocks have and how much uninfluence or lack of influence the bottom 100 stocks have in that market cap weighted index. So talking about tech, just transitioning, we got earnings last week from Microsoft, and Barron's talked about the tech bubble is slowly coming down. Perhaps we're seeing that not so much this morning as earnings roll in, and they talk about here's why. They talk about stocks like Netflix, which had tremendous performance, lots of subscriber growth, but Netflix during their earnings call said that they had some of that subscriber growth by pulling subscribers forward, so they do not expect to see super growth in the upcoming quarter. That disappointed Wall Street. IBM disappointed Wall Street even though they showed tremendous growth in their cloud business, which now makes up about 30% of their sales. But the other 70% of their business is struggling, and the street is not just focusing on that cloud portion of their business. Speaking of the cloud, we could talk about Microsoft, which had a very impressive earnings report. But what the street focused on for a stock that was priced for perfection, and again, don't want to report that the quarter was very good. Nevertheless, Microsoft had Azure, which is their cloud computing division's growth, come in at 50% currency adjusted, but it was growing at 60% the previous quarter. So the street, viewed that as perhaps a slowdown, albeit from a torrid pace. Again, trees can't just grow to the sky. And perhaps the most disappointing report came from Intel. Even though they had very strong earnings and significantly beat earnings expectations, but they revealed a large setback going forward, which is that they are struggling to make their 7 nanometer chip. May need outside assistance because their manufacturing prowess isn't up to the task, and the stock sold off significantly on that because the market is very forward-looking, and this is an excellent example of how the market is looking forward and is concerned that Intel is losing some of its mojo. So even though the quarter was very strong, the concerns that Intel may not be able to maintain their lead leading to that significant decline. We'll mention one interesting stock in the technology space that was mentioned in Barron's, and this is called Xperi Holding. The symbol is X-Ray Papa Echo Romeo. This is an obscure San Jose-based company that has piled up a collection of tech patents. And Barron's goes on to say, and they think that the stock, I'm sure it's up after this mention, but they said at the time the stock was seriously underpriced. They say that they built the company through a series of acquisitions. The cornerstone deal was just in June when Xperi combined with TiVo, the once iconic producer of digital video recorders. And with the TiVo deal closed, Xperi now has 11,000 patents. Many focused on video and audio technology, annual revenues over $1 billion, annual cash flows $420 million. Xperi has an enterprise value of about $2.4 billion, which is very low when compared to companies that have similar business models. Xperi is trading for around 2 times revenue. In order to address that issue, Xperi plans to divide into 2 companies. About half its business is going to come from patent licensing. That's from those 11,000 patents. And the other half producing software, which it monetizes with a licensing model somewhat similar to what Dolby does with their licensing model. An analyst at B. Riley and Company has a buy rating on the stock, $35 target. I mentioned the recent price is around $15. There also is a potential catalyst this week to both the up and the downside, and this has to do with a long-running patent dispute between TiVo, who they now own, and Comcast. TiVo has been asserting that Comcast's X1 set-top box violates its patents, and they've sued Comcast 3 times. The third trial decision is due this week. If they were to win, if Xperi were to win, they could win as much as $55 million a year in royalty payments and a catch-up payment of as much as $275. But the analyst goes on to say even if they lose or do not win, the stock nevertheless looks like a good value. We'll mention this morning also making headlines, Warren Buffett in the news. Lots of talk about Warren Buffett not stepping up to the dance in this pandemic market, where there was briefly a small opportunity for someone to swoop in and perhaps make investments. But Berkshire Hathaway did swoop in this past week and buy 33.9 million shares of Bank of America stock, about $810 million worth of stock at a price of about $24 per share. This is while Bank of America stock is off 31% year to date. It trades at about 1.2 times book value versus 1.6 for market leader J.P. Morgan. Berkshire now holds 981 million shares of Bank of America worth about $24 billion. It makes it the second largest equity holding of Berkshire behind Apple. Berkshire now holds 11.3% of Bank of America. Berkshire won approval earlier this year from the Federal Reserve Bank of Richmond to lift its stake above 10%. Buffett must really like the stock because he prefers to keep his buys and sells quiet for as long as possible, but because he was over 10%, he had to make a very quick disclosure. I will talk a little bit about the bond market. There was an article in Barron's talking about the veteran portfolio manager at Loomis Sales, Dan Fuss, who is considered perhaps one of the preeminent investors in distressed securities, almost 6 decades of experience, and what he has expressed is frustration in finding opportunity despite the volatility in the markets, but finding opportunity in the corporate bond market, he says is bordering on impossible. Dan Fuss points out that while the central bank's balance sheet has exploded by 50% to $7 trillion since it announced its aggressive steps, it has added just $44 billion in corporate debt because it didn't have to make the purchases, because just mentioning the fact that the Fed was going to potentially support the corporate bond market set off a stampede of corporate bond market buying by investors. This also allowed companies to issue more than $1 trillion in debt in the first half of the year, smashing the full-year record set in 2017. So he says, given bonds low absolute yields, you are not getting compensated for credit risk, in my opinion. The extra yield to compensate for the risk of holding a corporate security over a risk-free Treasury issue does look okay, but with Treasury yields near record lows, 60 bips for a 10-year and 1.25 for a 30-year, he says corporate bonds are producing too little return. He said that's true even in the high-yield market. So what's he doing? He said he's getting very picky about credit quality. He is up the average credit quality, and this again is a high-yield manager, to A- of his portfolio. And he's been buying treasuries if he must own bonds, because he feels that the return for the extra credit risk isn't worth it. But nevertheless, he's very unenthused by the low absolute yields that he's seeing. So what's a value bond investor to do in a situation like this? Well, what he says that he's doing, and I thought this was the interesting part of the kicker, is he's looking at purchasing value stocks up to the maximum permitted limits within his portfolios. And these aren't always just pure equities. He talks about hybrid securities, which might be convertible bonds, which might be REITs, might be preferred stocks, and different securities that he calls hybrid securities. He says he favors companies with strong financials, good market positions, relatively generous dividend yields, and a good record for raising payouts. He said you have to be very careful that earnings will be there to support the dividends and buybacks, and he points out also that you got to think about what is the corporate tax rate of the companies that you're investing in, because corporate tax rates very well may be subject to change if there is a change in administration or a change in the composition of Congress, and that could affect the ability of some companies to pay dividends if their tax rates were to increase due to those changes. So mindful of all that, thought it was interesting to see a veteran distressed bond investor looking at alternative securities. Perhaps the Federal Reserve would be happy, because perhaps that's one of the reasons that they drive rates so low, is to encourage that crossover buying. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.